Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, investment consultants, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out dakota.com to learn more about our services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. The statements made by Alec Garza represent his personal views and opinions and do not necessarily reflect those of Epic Funds or its affiliates. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, today we are joined by Alec Garza, managing partner at Epic Funds. We're very excited to have him today. Incubated at a $5 billion multifamily office, Epic Funds is a private market asset manager specializing in differentiated investments. The firm focuses on identifying and partnering with managers in niche, under-the-radar segments of private markets, collaborating through primary funds and co-investments to unlock distinct sources of returns and risk. The typical investment characteristics of an Epic Funds investment include managers with less than $2 billion in assets under management and funds in their first 4 vintages. Alec Garza, welcome to Philadelphia. Welcome to our studios. Thank you for being here.
Thanks for having me, Robert. Looking forward to it.
Congratulations on all your success. We look forward to sharing more about Epic Funds with our audience. Before we do, though, I want to say hello to my partner in crime, Tim Dolan. Tim, welcome back.
Thank you. Thanks for having me.
It's nice to see you not on the road, but you're heading out soon.
Yep. So we got Chicago on the books, Minneapolis, New York City. So like we've talked about on our other shows here at Dakota, just getting out there, meeting allocators and hopefully seeing some successes from our travels.
Well, we're excited to meet one of those allocators today. Alec, thank you again for being here. We have a lot of questions to ask you. Before we do, I'm going to read your biography for our audience.
Great.
Prior to Epic Funds, Alec spent 6 years with IWP Family Office in Denver, Colorado, where he focused on building and executing portfolio allocations for high net worth clients across public and private markets. His role expanded to private investment research and due diligence. Ultimately, Alec found that differentiated managers offered the potential for more compelling returns and diversification than more mainstream strategies did. Despite recognizing this potential source of differentiated returns, his family office clients often found it difficult to invest in these opportunities because they were difficult to underwrite and hard to access. These dynamics led Alec to launch the firm's first internal fund, what became Epic Fund 1, and to develop a scalable investment process that emphasized developing themes based on the current macro environment and recommending allocations based on a thorough evaluation of a particular market opportunity, fund size, and management team. Alec led all facets of launching what became Epic Funds, including vehicle structuring, leading the investment committee, sourcing, and due diligence. In January 2021, with support from the IWP partners, he established Epic Funds to pursue his passion for identifying niche and capacity-constrained opportunities in private markets. Alec is a graduate of the University of Denver, where he earned a BS in finance. He lives in Austin, Texas with his wife and their chocolate lab and spends as much time outdoors as he can. Alec, welcome again to Philadelphia. Congratulations on all your success and the dog.
Thanks. Yeah, she's getting up there in age, but she's still a gem. So
that's good. Can she keep up on the trails with you?
She's still got it. She's got two fake knees at this point, but she still loves to get out there.
Yeah, she sounds like a real ultra marathoner.
Yeah, something like that.
That's good. Well, thank you so much for sharing that, and thank you for being here. We do appreciate it. For our audience, who increasingly are more students and educators who tune in to learn about manager research and due diligence, they they always like to hear about the beginning. So
Yeah.
when you go back to the University of Denver, you were thinking about a career. What were some of the decisions that were going through your mind, and how did you ultimately choose this journey?
Sure. Yeah, I would say, the early days at the University of Denver weren't the path was less clear. I wasn't exactly sure what I wanted to do. If there was sort of a point that set me out on the right direction, there's a course called the Ryman Fund at DU, where we manage a portion of the university's endowment in public markets. We're actively pitching buys and sells on different securities. And I would say that this was the point where I really realized that investment research was something that I was interested in and enjoyed doing. And then things sort of snowballed from there. But I would say that, looking back now, it's clear like what the steps were that got me kind of where I am now. And, one book, you asked me about books earlier that I love is Range by David Epstein. And, in that book, he talks about the differences between specialists and generalists. And now looking back, like I think that I've always had this sort of generalist approach to life. I've always been curious. I've always been wanting to explore different things. And so in that investment research lens, I started working with IWP right out of college. I was an intern very early on. We were a super small team. And I realized through that firm, kind of the opportunity set within privates. You don't learn about it in school. No one teaches you about private equity or private credit. And so, that sort of introduced me to a new stream that I wanted to go down and really explore. And, I eventually realized kind of the opportunity set that existed, like you said in my bio, around kind of differentiated and nichier opportunities, the funds that people maybe haven't heard of, where there's really real opportunity for returns and better outcomes for clients, and ultimately pursued that path. And that's how we got started with Epic Funds.
Thank you for sharing all that. We'll be interested to see how the generalists versus specialists show up in the portfolio. I know Tim's got a couple questions on that front. You ended up spending nearly 7 years at IWP. Rather than have you take us through all of the months that were part of that journey for you, what were some of the more kind of important experiences that you took as you launched Epic Funds?
Yeah, there's an entire set of learnings from working with the ultra high net worth universe at a very young age. I learned a lot on that front. On the investment front, I think again, in school, you learn a lot about public markets. You learn a lot about equity research, especially if you're a finance major or into those things. As soon as I got into IWP, I realized that, the direction of wealth management was going towards passive investing, like with a lot of momentum. People had pretty much subscribed to the idea that you couldn't earn alpha through public markets, and it was better to have low cost index funds than it was to, build a portfolio of active management. And so then, it becomes, where do you add value as an investment advisor? What are the pieces of the puzzle that you're helping solve on behalf of your clients? And a big piece of that was portfolio allocation, which I helped with. And then the secondary component was this introduction to alternative investments in private markets. And how do we get our clients exposure in a thoughtful way to that category of investments? Because fortunately, all of our clients were qualified and, had the net worth to be able to do that. And so, that was kind of this reality setting in of like, wow, this world is not just like, what's my price opinion on Nvidia or Apple or anything like that. It's like, we're trying to get to, a certain point. There are goals, there are objectives in this individual or this family's portfolio that we're trying to hit. And what are the levers that we can pull to have the highest probability of success in so doing? And in the introduction to privates was, a big part of that.
So how did the experience at IWP specifically shape your approach to private markets? So when you think about those kind of foundational lessons that you were learning over the course of your time there, what did you find were the most meaningful that you've taken forward with you now in your career?
Yeah, specifically as it relates to privates. I mean, there was a moment in time where we kind of wanted to try to do it ourselves, where we were thinking about, investing in direct real estate or originating hard money loans, and you learn through your mistakes. And we realized and made a few mistakes that it was going to be incredibly difficult for us to fill the void in our client's portfolio of the magnitude that it was by doing it alone. We were doing a lot beyond just investing for our clients. And so it was this sort of, we need to figure out a solution how to do this. And through that is when, I realized, there are people who dedicate a tremendous amount of time to these very specific, verticals within private markets where they are more than justifying the fees that you were paying. Why are we going to go try to do it ourselves instead of, searching the universe for one specific manager to go accomplish that on our behalf or our client's behalf?
So how did you gather the confidence to go out on this entrepreneurial journey on your own? So I'm assuming it may have been the first time in your career that you kind of launched your own shingle, hung your own shingle.
Yeah, definitely. I mean, a lot of it comes from having people who believe in you and trust you. I think, and trust is a big theme in this industry and relationship building. And fortunately, I was able to demonstrate that at a very young age with the team at IWP. I think that helped build confidence in myself. It helped build confidence in the IWP team, the clients that we were working with. I got a lot of airtime with folks at a very young age and was forced to be able to articulate why we do certain things, and that helped. And so I always have had this desire to start something. I think if you had asked 18-year-old Alec what he was going to start, there is a probably 0% probability he would have said an asset management firm. But here we are. So yeah, it's been fun.
Yeah, you may have been worrying about your ski pass.
Yeah, that's exactly right. That's exactly right.
Instead of an operational infrastructure.
Yeah.
But how did you tackle that part of it? It's something I'm always interested. We're going to talk a lot about investments and asset allocation, the underwriting process for a manager. But you have to build something. You have to think about the operational infrastructure, technology, back office. How did you approach that part of this build out when you launched Epic?
I asked a lot of questions.
Good for you.
I found people who had done versions of this before and asked them as many questions as I possibly could. I think that it is extremely difficult to go about these things alone. And, it's always helpful to have an opinion or an idea or someone to bounce these things off of. And so, it was a lot of, you just pick up the phone or send an email and try to get answers. And the hardest part is starting. And that's true of so many things in life. The hardest part is just taking that foot out, stepping outside of your door to go on that long run. It's getting actually physically on the bike to start a ride. Those little things are so difficult, but once you do it, inevitably you get to the other side and it's wow, I'm so glad that I did. And so that's kind of how it was with Epic Funds. It was, we just need to start. We have a problem here that we are trying to fix. Let's just start and, start it on a whiteboard and kind of just build iteratively through that.
A blank whiteboard can also be overwhelming, particularly when you're thinking about asset allocation and asset classes that you want to present to your clients. Looking at Epic Funds, you're investing in a variety of asset classes within private markets. So how did the decision kind of come about to be kind of a generalist as it relates to optionality?
We're certainly a generalist in our ability to navigate and explore different areas within private markets. But at the end of the day, any fund or any opportunity that we are looking at, there's a mutual agreement between us and our LPs where our job as an asset management firm is to earn the highest return possible within a given set of parameters, right? And those parameters are defined in whatever the fund is that we're structuring or whatever the opportunity is that we're pursuing. And so we intentionally have a broad lens so that we can see the opportunity set and pull, information from one, maybe private equity firm that we've seen that's leveraging private credit in some distinct way, and then apply that to, our pursuits in private credit. So the wide lens is super important so that you don't get so narrow in your focus that you miss, the broader opportunity set. And by that, it's not even hey, we want to go chase those things. It's awareness. It's the awareness is so important. And, there's not really an easy way to Google, who are the best asset-backed lenders, sub $2 billion in the US. That, you're going to get nothing. So you have to have this visibility. You need the generalist lens. And then that all helps, build on top of each other. It's
been about 4 years or so. So over that time period, have you seen any evolution in the way that you approach managers or just kind of overall investment philosophy?
Yeah. The core of our philosophy hasn't changed. And we think that there is an opportunity for most people to add smaller, diversified and niche opportunities to their portfolios to help accomplish or achieve better outcomes, or with a higher probability of achieving the outcomes that they are pursuing. So that has remained true. Of course, there are subtleties to that, and the macro environment is changing, and especially right now, it's changing very quickly. So we've adapted here and there, but the core of it has remained the same, which is we're trying to find people who have, durable investment strategies that are below the upper ends of competition through, these mega funds of the world, where you can structure better deals, more protections for yourself. You can influence the outcomes of the investments a little bit more, and you don't have to necessarily rely on public markets as an exit or something like that. And so we love that kind of thing. That still persists, and it's still at the core of our investment philosophy.
I like to hear durability. I think that's a great way to describe, particularly smaller, more emerging managers.
Well, Alec, that was a great background, great overview. Again, congrats on everything that you've built. And as we get into the investment process at Epic Funds, maybe for our listeners, it'd be interesting to hear just an overview of the platform, current investments and strategies that you have today, and then maybe what's in the roadmap. What are you thinking about creating down the road?
Sure. So we're like I said, a diversified private market asset management firm focused on differentiated opportunities. Today, we're 165 million or so of assets under management, and that's through 3 primary commingled fund of funds, where we build diversified portfolios for our clients within these categories. We've made close to 63 investments since inception, so we have done this a lot. We have gone through the due diligence and investment process many times for these funds and underwriting different managers. And, that varies from early stage VC all the way through private credit. Like I said earlier, our funds do have specific return targets or diversification thresholds or things like that we accomplish or seek to achieve. But that's throughout the entire universe of private markets.
Within those 3 funds that you have created today, is there a certain style or theme across those 3? Is it a credit oriented, income focused? Is it the private equity focus, or is it more of a multi-strategy across the 3?
Yeah, it's a really good question. And I wish that the answer to this was simpler, but you again learn along the way. In the early days, we had these closed-end commingled funds with 2 share classes. And the share classes were basically based on a set of objectives, growth or income. Mm-hmm. And so in the growth category, that's where we were able to invest in things like early stage VC, real estate, private equity, things that had kind of a higher return and longer duration expectation. In the income share class, that's where we spent a lot of time in income producing real assets and private credit. We have since evolved from that model after our second fund. Today, we're strictly investing out of a private credit focused fund of funds.
Got it. So that was going to be my next question, is obviously within the private credit strategy, what other themes or sectors are you guys finding attractive right now as you look over to the rest of 2025 and going forward? Yeah,
I like to say that we don't necessarily need to be contrarian to be successful. We're applying consensus thinking just in an area that is less trafficked, honestly. So, private credit, for example, has gotten a ton of airtime recently. And I think it's justified. There's a lot of money going to private credit. But if you actually unpack where the headlines are coming from and what people are talking about, it's the upper end of the private credit market. It is a very specific sliver of, the overall industry. Now, again, most people haven't spent the time to go through and look at all of the different nuances around asset-backed lending or specialty finance or those types of things. So for us, we think that the tailwinds in the private credit industry are still holding true. That is, there's a bank retrenchment, meaning there are fewer lenders out there from banks originating loans to smaller companies. And so that void is being filled by private credit. And so for us, that looks like a lot of asset-backed finance. That looks like a lot of specialty finance. People who are kind of taking advantage of that lack of capital and really, stepping in, whether it's to lower middle market companies that are, mom and pop owned who want to go make the next acquisition of equipment, or perhaps buying an invoice from, a farmer who has credit to, Kroger or something like that. Like there's a huge universe of opportunities kind of further downstream, but all based on the same broad category, which is fewer lenders are out there.
Yeah, that's definitely very interesting. And we'll get into more kind of opportunities and asset classes within private markets that you are finding attractive. But maybe just taking a step back within your investment process, right? As a fundraiser, we're always thinking about, right, like what does that process look like? So cold call, cold outreach, right? That first meeting. Can you walk us through that investment process? Like, what do you like to see? What do you don't like to see? What are some of the best meetings, some of the worst meetings, et cetera?
Sure. Yeah. So I like to distinguish two things. Like we have our investment process, which is sort of what you're talking about, where it's like more of an information, gathering, learning, discovering process. And then there's the due diligence process. Once we've said go, and that's like a fact-finding mission. We're checking a lot of boxes to make sure that we're covered here and there and references, et cetera. From the investment process perspective, the meetings that tend to be most productive for us, and I think, we were sort of talking about this earlier, this is a long-term motion. Like there is very few instances of, less than 6 months we're now invested in a fund. We're getting to know people over years. And so much of our industry is based on those relationships and trust. And you can't really artificially create that. Like you have to get to know the people on the other side. And so the more authentic, the more opportunities to talk to the decision makers in like a low stakes format, honestly, I find super helpful.
No, that's great. And trust me, we appreciate the longer sales cycle and that comfortability. And you touched on it at the top of the show, trust, right? It's getting that trust that IWP gave you, but also you need to be able to provide that trust to the fund managers as well. So yeah, it makes complete sense. Just moving forward through kind of your investment process and thinking about the managers that ultimately get into the portfolio. What are some of those traits? Is there some commonality across those managers? Obviously, you like the asset level being less than $2 billion, kind of earlier in their vintage life. Anything else that kind of rhyme across managers? Yeah,
there's some sort of key themes that I think you can apply to the types of investments that we pursue. Usually they're smaller markets, they're misunderstood assets, or they're new strategies. And so maybe I'll just give you an example of a manager that we've invested with that I think exemplifies this pretty well. We were introduced to a group called Maritime Partners, which is an inland marine leasing strategy in 2017. They were a $50 million fund, and the basis or the thesis was, hey, there's this, very fragmented ownership pool of towboats and barges across the US that are moving core commodities. They're super valuable to own. They operate on triple net leases. We're going to go start aggregating a portfolio of them. They were $50 million when we met them and maybe 20 assets, but we got to know the people. We got to know Bick. We got to know Austin. And through that relationship, we really built conviction in what they were doing. Now, that is never going to be a $10 billion fund. It's not going to, scale up to to be in the radar of some of these larger institutional allocators. And that's what I mean by small markets. It's like sometimes you can have really good investments. They just can't get that big. Like there's a ceiling on how big they can get. And we love that.
No, that's helpful. And obviously a lot of our listeners are smaller and newer. So probably music to their ears, probably get a few phone calls and emails after this, which is always good.
Can I ask a quick question just on that track? How would you define your competitive edge in sourcing a manager like that?
Yeah.
So what makes you unique where they'll take your call and approach you? I know they're small, just like a lot of our clients are that listen in. But when you think about sourcing, how do you differentiate yourself relative to other fund of funds?
Sure. I think, we have the benefit of doing this for close to 10 years now. And we've been saying the same thing for, like I said, you asked me the question about what's changed. We've been saying the same thing, which is, hey, we like to look at, smaller managers that are capacity constrained by design. And we like people who understand the business that they're building. If you're trying to go build the next, Blackstone, we're probably not the right person to talk to. Like that's just not the type of manager that we're pursuing. We're looking for somebody who is doing something very specific in a domain that they have, high expertise in and partnering with them to go execute on an investment strategy. So what gives us edge is a lot of pattern recognition. Like I said, done this close to 60, plus times. You can pull anecdotal pieces from all of those things. There are lessons learned, scattered throughout all of those investments that we now have the benefit of leveraging as we're trying to make more decisions. The other piece of this is candidly like networks and the network effect. I mean, I spend a lot of time with other CIOs and allocators and investors just sharing ideas. Like I am an open book when it comes to who we're investing with, because I don't believe that it's a zero-sum game that I'm going to take someone else's allocation or anything like that. Like chances of that happening in the universe that we operate in, extremely low. So I would rather have all of these nodes spread out across the country that are also taking in inbound and sifting and then saying, these are the things that I think are interesting. And then, corroborating that and saying like, well, wait, I do too. Like maybe there's something here that we should both lean into and explore. So yeah, the network is huge.
Thank you for sharing that.
Yeah.
And Tim, thank you.
Yeah, of course. I'd be curious, right, thinking about a lot of these strategies, sub 2 billion, earlier in their life cycle. How do you think about an emerging manager, whether they're on fund 0 effectively launching? How do you get comfortable with that manager?
Yeah.
Whether it's track record, prior role, walk through those earlier vintages and how you ultimately get to a decision there.
Yeah. Well, so much of it, again, and not to sound like a broken record, like the people aspect of this business is so important. Mm-hmm. And as you get to know managers who are starting these businesses, like they've taken a risk, right? More often than not. And for the managers that we like to pursue, it's usually not like their first endeavor in life. This is not like they're coming out of college and launching a new fund and like, this is the first commercial exercise that they have done. It's, hey, we were doing this inside of a big firm and they told me I had to stop doing loans this small. And so then they leave and they start their own fund. They're taking a risk. Like there is something there. And similar to what you guys do, like I want to ask questions. Like I want to get to know them a little bit. Like what are the character traits that, are motivating you to pursue this? And the people where it really resonates and where you really understand kind of the motivations, it's like, they are passionate about what they do. And then there's the component, like if you can get comfortable with the character, with the people, then it becomes an investment question. And it's, do we as an investment team, can we build conviction in what they say they're trying to do? Are there enough data points that we can reference either from other investments or from them and their background and whatever they were doing prior to build conviction that this is real? Emerging managers can mean a lot of different things to a lot of different people. And, I think that categorization sometimes is challenging to use because, for me, someone spinning out of, a big firm who's been doing this for 15 years still sometimes qualifies as an emerging manager. I don't think of them that way. Yeah. Like I don't at all. I actually think they're just a manager. They just happen to be smaller and newer. And like that comes with certain risks, but you can underwrite that.
I have one question, and again, it might be too concrete because again, we talked before the show of this is the long game, right? But are there any asset classes that like maybe today or over the next 3 to 5 years that it's like, we're probably not going to be touching those areas just for whatever reason, or you know what, Tim, today it's not a fit for what we do, but it could be over time.
Yeah. I would say if you see, name big endowment writing a $250 million commitment to a fund, it's not a fit for us. Like I can pretty much guarantee you that is true. On the other side of it, like things that we're interested in right now, I mean, our investment team is spending a lot of time kind of in real assets and thinking about not just on the lending and the income producing side, but like longer term focused real asset strategies that, again, maybe don't scale up to be a 5, 10, $15 billion fund, but are in the 200 million to 750 million and doing something really unique and interesting. So, these things sort of change and ebb and flow as macro changes, but at the end of the day, it's all about kind of the motivations of the people behind it. And one thing that, I do want to add, which I haven't mentioned yet, related to kind of smaller managers, the incentive piece of this puzzle is super important. Mm-hmm. Like, are the people bought in both financially and from like a lifestyle perspective to go and execute what they said they're going to do? Like those incentives matter so much to the success. Like that's what we have seen. When there is challenges, it's, oh, well, maybe the incentive structure wasn't quite right, or, they were actually exploring other things while they were doing this. So the incentive piece of this puzzle is super important. And the more a manager can demonstrate that through, again, a personal investment or whatever, the better. Like that helps.
I always find it so fascinating when a manager runs their business, also how they allocate as well.
Yeah.
Right. Because you are effectively, right, you're out there trying to raise capital for your fund of funds as well. And you're thinking about it, your own business from an incentive standpoint, and all those are aligned. You want to see the similar things in your underlying managers, which makes complete sense.
Yeah.
Alec, you talked about pattern recognition. You talk about incentives as well. Can you take us in the room? So you're meeting a manager for the first time. I'm always very interested in the qualitative aspect. What types of questions are you asking that manager to get to know their character, to build that trust and that confidence to make an allocation in something that your peers aren't looking at?
I think a lot of it is background information, honestly. Like, we started this interview kind of on my background. Like, I really don't like meetings where we just all of a sudden get into like investing right away and like get into the topic. I want to understand who's on the other side. And I think, maybe one of the things that I find sometimes challenging is not having enough access to that person or their opinions or their thoughts to really feel comfortable with the decision maker. But specific questions, things like, what's your plan with the firm long term? How big do you think, you want this to be? Tell me about your competitors. Like it really isn't like some novel or unique question that I necessarily have as like a gotcha, or like that's how I know someone's character is I agree with their character or their personality or whatever it is. It's just a discovery process. It's just getting to know people. And like, that's fun for me. It's fun to get to know people. And that takes a lot of different forms, honestly, in the early days of investing. Like I said, there's the due diligence process where it is much more of a fact-finding mission. Like you do background checks, you do all of these things where it's like, I am just checking to make sure that everything that you told me over the last 2 years is true. So hopefully that gives you kind of a little sense.
It does. And you've done enough meetings now. Is there anything you just don't want to hear? As soon as you hear it, you're like, okay, thank you for the meeting. We appreciate your time.
Gosh.
We just raised $200 million from an endowment.
Yeah. I was going to say that's a good one. Sometimes the fund size right away, I'm like, oh yeah, okay, this isn't good. Or my first fund was 150 million and we think we're going to raise, 1.2. And I'm like,
not your cup.
Yeah, I think we're good.
I was curious. You're investing in early stage venture, and the early stage venture manager who's evaluating those companies puts a lot of expectations on those companies. They need to know their business inside and out, product, opportunity set, market. But I find the irony in that a lot of those managers don't necessarily know their business. They know how to invest, but they don't know operations. They don't know sales. It's one of the reasons Dakota gets a lot of calls. How important is it when you're talking to these earlier stage emerging managers that they understand their business, not just the investments, but the business itself?
Yeah, it's huge. And not just like the commercial piece of this, like how are you actually going to, pay for overhead and people and all of those things. It's the people management of the business too, that I find extremely important. Like when you have a signal or a firm that has super high turnover, like my alarm bells go off and flags go up, like what is going on here? So yes, I mean, it's a great point. I think you're right. I think that, and Tim and I talked about this, distribution is one of the hardest pieces of this puzzle. And, if I were to go back in time to when we were thinking about launching this firm, I grossly underestimated how hard fundraising was and how hard and how much time the person, in the CEO role or managing partner role, whatever it might be, needs to spend marketing out there, meeting people, talking, doing things like this. It's much higher than I thought. And I think when you underestimate that, you can kind of get trapped in like no man's land. So it's tough, but
it's still a good observation. And folks at Dakota have done a good job of helping to flatten that environment. So thank you for sharing all that.
Yeah.
Before we kind of take a step back and look at the universe of alternatives, mostly based on the writing that you've put out there, which is very interesting. So I do want to plug that as well. You've got a lot of great content on your website. When you think about technology and you think about the use of technology at your firm, how are you utilizing, financial technology and the types of tools that are available to you to make the business more efficient?
Yeah, well, and if I may, for just a quick second, I do think it's interesting just to kind of explore like the evolution of technology in this space. I mean, when I started, and I'm sure you guys are familiar with this, everything moved in password protected PDFs. So like we're coming from a place of like very, very, very little technology infrastructure built around alternatives. I think around COVID is really when this sort of narrative began of the shift in, high net worth investor dollars going into alternative and private market investments. And I think that unlocked venture capital money and private equity money to come and invest in technology in the space. And so there's been sort of two flavors of what's come out of that. One is, the likes of Case and iCapital, which are building, basically digital distribution platforms to help, large managers get exposure to this space. That's one flavor. I think that's good. I think that they do a good job on education. They do a good job, introducing people to what's happening in this world. And then the second piece is more of the actual infrastructure build out of like, how do you get a subscription document, between a client? And so for us, where we've focused is really on improving that LP experience, right? It's like, can we leverage technology to make the LP experience better? That originally started with a group called Subscribe. Rafay and his team, when we talked to them way back in the day, they were just getting going. And that was kind of our first foray into digital subscription documents. And they've done a great job of building off of that and making, that kind of initial piece of the investment process easier for our LPs, which is great. Then you have like the actual fund operations components where, we work with a company called Arch. Ryan's a good friend. They are basically a single sign-on platform to get exposure to all of your documents across, different investments that you've made. So, we have 60 investments. We probably have 50 sign-ons to different investor portals to go pull documents. Like it is a massively inefficient process. Arch solves that problem on our behalf. And then that all allows us as a firm and a team to spend more time doing the valuable things, which is, update calls with individuals or, improving the speed with which we can deliver investor reporting. So that's how we think about technology on the operations side of the business is how do we make the LP experience better with the tools that are now kind of coming to market.
In addition to this pace of technology that seems to be changing every day and the tools that are becoming more accessible to firms like yours, which are very interesting. Thank you for sharing that.
Yeah.
It seems like there's also no slowdown with consolidation. So when you think about the industry and your competitors getting bigger and those who may be looking at you for an investment, so those potential LPs of Epic funds also getting bigger, just a significant amount of consolidation. How do you see that reshaping competition and deal flow for the industry as it relates to your business?
Yeah, I mean, the consolidation piece is super interesting. On one hand, I can totally understand the perspectives of a GP that are going into some of these larger platforms because like we talked about, distribution is one of the hardest pieces. And, being able to have a brand that is recognizable behind you is super valuable. I also think that some of, the GPs or the managers have been building their firms for, multiple decades. Like I can understand a little bit of liquidity and trying to make sure that it's set up for sort of the next generation. So on one hand, I understand the GP consolidation piece. What does it mean for us? I don't remember exactly what the fundraising number was, but it's something to the effect of like more than 50% of funds raised in 2024 went to like the 10 biggest names. So it's a crazy fundraising environment. It means it's that much harder for these smaller, more nichier managers, one, to get airtime. Like they don't have 200 person sales staffs to go run around the country, telling the story about, X Fund 15 or whatever it is. So that makes it harder to find some of these managers. I think that the universe is growing though. Like there are more managers out there raising money that are smaller. It's just more difficult for them to actually get to a close. And like I said earlier, that's why I like to, share deal flow with friends and bring other allocators in, because it's tough. It's tough to raise money. And so I'm a big advocate for kind of obviously the smaller fund universe and smaller managers. Like I think that they exist for a very specific reason and should continue to exist. And I don't think that all investment dollars are just going to flow to the top forever. I think people eventually may be disappointed with the outcomes of their investments on that. And that's when you'll kind of see the change in preferences. We as a team talk about this sometimes too. It's interesting to just sort of ask the question of like who wins at the end of the day. Like, does the asset management firm win because it's now easier for them to raise more capital and they just grew their AUM by a couple $2 billion, or do the investors win because they actually have better outcomes? And like that's TBD. We'll see. I would guess you could, or I would bet you could guess where we believe the conversation goes, but there's still more to find out.
No, I appreciate that. It's not the real estate market. It's hard to know when the buyer or the seller has the advantage.
Yeah.
It takes a little bit more time and it's not quite as transparent.
Exactly.
Thank you for sharing that. So Alec, as I said before, I spent some time digging around your website and I saw you had written a bit about the rise of continuation funds and evergreen structures, which reflected a change in today's liquidity environment. Do you think these structures are here to stay, and how are you approaching these innovations?
Yeah, we've definitely seen a lot of innovations and fund structurings over the last, call it 5 or so years. I think I would break the two apart, like between continuation vehicle and evergreen fund. I think, continuation vehicles have been around for a while. Like it is not a completely novel structure, but managers are certainly leaning in today in an environment where there are very few exits. Like they are trying to figure out how to get LPs money back. And I think that, they can be a useful tool for that. But if the last, call it decade pre-COVID is any indication, like I don't think that there's necessarily a desire from most LPs for that to exist. The relationship between investor and manager is to return capital in the private markets. Like that is the relationship that I think most people subscribe to, is like, I'm giving you $1 and I expect $1.50 back in, 5 years. So I don't know that continuation vehicles are going to be around with the same sort of scope or attention that they're receiving today. On the flip side of that, evergreen funds, I think, solve a real need for LPs. I think that a lot of LPs struggle with the cadence of closed-end funds and struggle with figuring out how to honestly stay invested. And this was another learning from IWP. It's like you can put a 20% allocation to private credit, on a table and say, this is where we're going. But you're only ever very briefly there when you're investing in closed-end funds. You go like this, you build an allocation, then you start getting capital back. And it's like you start over, you go up and down and up and down. You're never at 20. So evergreens help solve some of that problem. They offload a little bit of the operational complexity from the LP to the manager. And in a lot of circumstances, I think that that's good. The type of evergreen fund where I have some concerns is more when they're being presented as liquidity solutions. When it's like, hey, you can have exposure to private markets and it's liquid. Mm-hmm. That, to me, it doesn't align. And unfortunately, we do see some of that. So yeah, I think, again, the vehicles and the innovations and fund structures that are solving like real demands from LPs will, be around for a long time. I do worry. I think the biggest potential, roadblock or challenge to that is if one of these more public vehicles, you sort of saw it a little bit with BREIT, like when these more public facing alternative solutions have some difficulties or challenges, like that could really put a big overhang on the rest of the market. So we'll see.
Yeah, certainly slow things down.
Yeah.
I'm curious. So I do teach early stage venture capital at Drexel University. Okay. And I'm curious, other than artificial intelligence, what other trends are you seeing within early stage VC?
Yeah, I think that the health and wellness sort of investment universe and landscape is definitely growing. I think that people care more about that now than they did previously. Biotech has always kind of been like, it's hot for a little. It's really hard to make money. If you do, you make a lot of money. That's another one that I think, we are seeing some groups there. The energy focused VC strategies are super interesting. There is kind of like some structural tailwinds to that. You've got batteries, small modular reactors. Like there are things within the energy and infrastructure and real assets segments that venture certainly will have a role in going forward. And obviously there's some technological challenges to some of those things, but I like to see that people are investing in it. I think defense is another one that has gotten a lot of airtime recently, and we've definitely seen more attention and more desire from LPs and managers coming online that are saying like, hey, we want to invest in US infrastructure and continuing to build on what we have. And, we've underinvested in defense for X number of years. Like we hear that pitch a lot.
Interesting. Thank you for sharing that. There's no shortage of innovation in that space.
Certainly not.
Sure. So how do you balance that innovation with the need for risk management?
Yeah, I love this question because we do live in a universe, in a world where VC and technology and change is always like the top headlines around like, these are the things that's changing. So there's a lot of pulling towards that, I certainly feel in my role is like, wow, like, is there an opportunity for us to innovate? But at the end of the day, the innovation needs to come with a purpose, and our role within an investor's portfolio is really to solve this category of differentiated and niche opportunities. And the only innovation that we're going to do is to further increase our probability of accomplishing that on behalf of our LPs. So we already talked about the LP experience perspective of that. On the investment side of it, like we haven't really changed all that much. I mean, we have some tools that we use. We do some things differently than we used to around, aggregation of data and being able to, run quartile rankings much more quickly than we were able to in the past. And like we've invested a lot of time and energy and effort in that, but we're not chasing some novel strategy to put LP capital to work. We're using technology just to make us better and to make the LPs, happier and hopefully accomplish better outcomes.
That makes sense. Thank you for sharing
that.
So any endurance races on the horizon?
Yeah, actually. So to back up for the listeners, like I have recently found a love and a passion for endurance sports. And so, I'm not by any means like a professional endurance athlete. I find that the ability for people to endure for a much longer time than they think are capable of is a super interesting, just thing to observe. And as a fan originally, and then now, kind of trying to do some of it on my own. And then on top of that, like endurance sports, like there's a ton of data, there's a ton of information. Like for me, if someone who likes to just like go down rabbit holes, it's the best rabbit hole. There's so much to explore and learn and tinker. So I have a couple races this year, a couple of gravel bike races, and then one half Ironman. So
okay, great.
Yeah, we've got two guys at Dakota training for Lake Placid Ironman. So
nice.
You can join up with that.
Yeah, maybe. I'm not quite there, but if they're doing a full, I'm not quite on the full train yet.
I'm sure they'll say if you can do a half, you can do a full.
Yeah. I had a friend who did endurance races. He used to say, I'm not a professional endurance athlete, but I am a professional glutton for punishment.
Yep.
So it seems like you enjoy the longer race, which is good. And it's reflective of what you're doing. A lot of these investment managers that you are focusing on are, in it for the long term. They have to be durable and resilient.
Yeah.
So I can certainly see the parallels.
Yeah, there are a lot. I mean, we could probably do a whole nother podcast talking about like the parallels between endurance sports and investing or life just generally. Like, you learn all of these things. I will say that there are like two kind of main themes that I've pulled from exploring endurance sports that I kind of think about regularly as it applies to building a business. And like one of those is kind of just the importance of racing your own race. Like, it's so easy to get caught up in what other people are doing and like, oh, this fund just closed with this many dollars. Like, that's crazy. Like, why weren't we in it? Whatever. It's very easy to benchmark yourself against other people, but we're in a very long game. Like, we have to incrementally, stack those bricks and build the foundation. And I believe in, 10 years, we're going to look back and be like, holy cow, like now look at where we are. But that requires a lot of dedication. It requires staying true to who we are. It requires, being very explicit about our goals and what we're trying to accomplish. And then, having a high standard for ourselves and like I said, stepping out the door to start, like doing those things every day that just sort of incrementally build on top of each other and compound. So, that's, I guess, probably the biggest kind of realization or applicability between endurance sports and building a business.
I appreciate it. I could have also spent an entire episode talking about that. I also enjoy them as well. And actually, in advance of the conversation, I reread an essay from Outside Magazine called 60 Hours of Hell. It's about the Barkley marathons. They're down in Tennessee every year. And the guy who puts it on changes the course. It's a 100-mile run. And he changes the course every year. Only 14 people have ever finished it.
Oh,
and it's inspired by somebody who had broken out of a prison, 100 years ago and survived this journey. But it just made me think about, the importance of preparation.
Yeah.
You don't know the road ahead sometimes. And like you said, we could talk about it all day.
Yeah, yes.
Before we let you go, we always like to ask our guests about the mentors, the people who have helped them in your career.
Yeah.
Anybody you'd like to mention or any experiences that stand out for you?
Sure. I mean, first off, I certainly need to call out my parents here. I mean, they played an important role early on. Today is actually my mom's birthday. So happy birthday, Mom.
It'll
probably be a little late, but happy birthday. No, I think that, my parents really gave me the flexibility to explore a lot growing up between different sports. I mean, I tried every sport under the sun, honestly. Like, I just loved sports. And the other piece of it, which I can reflect on this now, was just understanding like decision-making and risk in a way. My dad always used to say, like, you can do whatever you want, but there are consequences. And like, if you're not going to think about those consequences, suit yourself. So that was kind of a funny, or just something that is applicable. But from a career perspective, Kevin from IWP has been, a huge advocate for me, like I said, at a very early age when I candidly don't even know if I deserved it. But he threw me into the ring and, said, I believe you're smart enough to figure this out. Go do this. And, he's continually been a person that I go to anytime I'm trying to think through a problem or, just want to, talk about life or whatever. So, he's been big.
Well, he made the right call on you. Thank you for being here. We learned a lot today. So thank you for taking the time to share your insights, share your experience with Epic. We wish you nothing but good luck and future success. So thank you so much.
Thank you guys. I enjoyed it. It was fun.
Yeah, we did as well. If you want to learn more about Alec and Epic Funds, please visit their website at www.epic-funds.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We're also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at dakota.com. If you like what you're hearing and seeing, please be sure to like, follow, share these episodes. We welcome your feedback as well. Alec, thank you again. Tim, thank you as always. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.